Welcome to the deep dive. We're here to sort through the noise and give you the real scoop on topics that matter. Today, we're jumping into something that sounds, well, maybe a bit technical: accounting changes. Specifically, we're going to focus on change in accounting estimate.
Right. And it sounds technical, but trust me, it's got some really interesting real-world sides to it.
Exactly. It affects how companies report their financial health, how investors see them, and as we'll get into, there's a pretty major case study involving, let's just say, things not being done in good faith.
Oh, yeah. That one's a biggie.
So we'll break down what estimates are, how companies handle changes, and what you really need to keep an eye out for when you're looking at financial reports. But before we really dive in, just a quick reminder, this deep dive is based on material from Farhat lectures. All the content, the examples, the explanations, it all comes from the great accounting resources over at farhatlectures.com. So whether you're maybe an accounting student studying for the CPA exam or you're already a professional, definitely check out the website. They've got extra practice questions, video lectures, lots of support to help cement what we talk about today. And a special thanks to Professor Farhat for providing all this valuable material.
Absolutely. Great resource.
Okay, so let's get started. Accounting estimates. It kind of sounds like companies are just guessing, but it must be more precise than that, right?
Yeah, you hit the nail on the head there. It's not just guessing, though estimate definitely implies some uncertainty. It's really about making the most informed judgment possible. And, they're absolutely essential.
Why, son?
Well, because the future is inherently uncertain, right? Companies have to predict future stuff that's going to affect their current financials. Think about bad debt expense. You're estimating who might not pay you back.
Okay.
Or warranty expense, predicting future claims on products you're selling now.
Yeah.
Allocating deferred costs over the time they benefit the company. Even income tax expense is an estimate till everything's finalized.
Yeah, right.
Inventory obsolescence is another one, figuring out what stock might go bad or become unsellable. And probably the most common one, the one we'll focus a lot on today, is depreciation expense.
Depreciation, yeah. That seems like a big one.
It is.
Yeah.
So these aren't wild guesses. They should be reasonable assessments based on all the available info and management's best judgment. And just quickly, there are actually three types of accounting changes: principal, estimate, and reporting entity. But today, yeah, we're all about estimate changes.
Yeah. Got it. So if a company realizes, hey, our estimate needs to change, how do they actually report that? Do they have to go back and fix old reports? I've heard retrospective used for some things.
Ah, good question. And this is a key difference with estimate changes. They use what's called the prospective approach.
Prospective, okay.
Yeah, it means the changes are only applied in the current period, so right now, and then in future periods. The really crucial point here is companies do not go back and change prior financial statements. No adjusting old retained earnings, nothing like that.
Ah, I see. So they just draw a line in the sand and say, okay, from this point forward, we use the new estimate.
Exactly. Which, as you might imagine, is a lot easier than the retrospective approach you mentioned.
Right, because retrospective means redoing past numbers.
Precisely. Going back, restating past financials as if the new principle or whatever had always been used, it can be a huge headache. Imagine recalculating everything, rebooking entries into beginning retained earnings for past years.
Yeah, that sounds like a nightmare.
It can be. So perspective is simpler for the company, practically speaking, but it also means those historical statements stay as they were originally published, reflecting the best estimate at that time.
That makes sense. Simpler, definitely. But does that create any issues for someone like an investor trying to compare results year over year if the past numbers aren't adjusted based on the new estimate?
That's a really sharp point.
Yeah.
Yes, it absolutely can. Because those prior periods aren't restated, if you're trying to spot trends, you need to be aware that the basis for certain numbers, like depreciation, might have changed. You can't just blindly compare this year's expense to last year's without checking if the underlying useful life estimate, for instance, is still the same.
So where do you find that information?
The footnotes, that's where the gold is. Footnotes to the financial statements should explain significant changes in estimates and give you that context.
Okay, footnotes are key. Got it. So this prospective method, let's make it really concrete. You mentioned depreciation. Can we walk through an example, maybe this Adam Company one from the source material?
Perfect example. Let's do it.
Okay, so picture this. Adam Company buys a building. Cost, $500,000. Initially, they figure it'll last 10 years, no salvage value at the end, straight line depreciation. And they've been recording depreciation for 4 years already.
Right. So original calculation is pretty simple. $500,000 cost divided by 10 years. That's $50,000 in depreciation expense each year.
Okay.
After 4 years, they've recorded $50,000 times 4.
Yeah.
So $200,000 in accumulated depreciation.
Makes sense.
So now we're at the beginning of year 5.
Yeah.
The building's book value, its cost minus that accumulated depreciation, is $500,000 minus $200,000.
$300,000.
Exactly. $300,000 book value. That's the starting point for the change.
And then, bam, January 1, year 5, they decide, you know what, this building's actually going to last longer. They revise the total useful life from 10 years up to 14 years, so an extra 4 years.
Yep. So now we apply that prospective method. We take the current book value, which we just figured out is $300,000, and we need to figure out the remaining service life based on the new estimate.
Okay, how does that work?
Well, the new total life is 14 years. They've already used up 4 years.
Yeah.
So 14 minus 4 gives us
10 years remaining.
10 years remaining. Right. So you take that current book value of $300,000 and divide it by the 10 remaining years.
Okay. $300,000 divided by 10, that's $30,000 a year.
Exactly. $30,000 per year is the new annual depreciation expense, starting in year 5 and going forward. And look at the impact. It went down from $50,000 a year to $30,000 a year.
Wow, yeah. That's a pretty significant drop in expense each year, which means higher reported income, right?
Absolutely. Less expense means more profit hitting the bottom line.
Right.
And for a big asset, that change can be very material on the income statement.
Okay, so we see how it works mechanically with Adam Company. But this isn't just number crunching. When a company changes an estimate like this, what are the sort of bigger picture implications? For their credibility, maybe.
Now you're getting to the really critical part, the good faith rule. Yes. Changes in estimates are allowed, and sometimes they're absolutely necessary because, circumstances change, you get better information. But, and this is a huge books, but they must be made in good faith. Adam Company, presumably, had a legitimate reason to think the building would last longer. Maybe they did renovations, maybe industry standards changed.
Okay, so it has to be based on real reasons.
Exactly, because this flexibility, well, it can be abused, and it has been. There's a really powerful and, frankly, quite disturbing example of this, the U.S. government versus waste management case. It was heard in the Northern District of Illinois.
Waste Management, the big trash company.
The very same. This was a massive financial fraud. We're talking high-ranking officers deliberately hiding the company's real financial situation. They basically cooked the books to hit the earnings targets Wall Street expected.
How'd they do it?
A bunch of ways.
Yeah.
They concealed operating realities, lied to investors, lied to the public. The company eventually had to admit it overstated its profits.
We'll wait for it. $1.7 billion over several years.
$1.7 billion. Billion. With a B. It was huge. And a key part of their scheme, relating directly to our topic today, involved estimates. They improperly eliminated or deferred expenses they should have recognized. But critically, they avoided depreciation expense.
How? Like the Adam Company example, but just...
It's not exactly like that, but taken to a fraudulent extreme. They arbitrarily extended the estimated useful lives of assets, things like their garbage trucks. Just decided they'd last longer on paper to reduce the annual expense, and they didn't stop there. They also made totally unsupported increases to the estimated salvage values of these assets.
So double whammy. Longer life A&D, higher value at the end. Both reduce depreciation.
Precisely. These weren't good faith adjustments based on new information. They were blatant, deliberate manipulations designed purely to inflate profits by cutting a major expense.
Wow, that's staggering. It really puts the importance of good faith into sharp perspective. For people analyzing financials, what are some maybe subtle signs or red flags? How do you tell a legitimate change from something fishy, even if it's not full-blown fraud like waste management?
That's a great question, because it's not always black and white like the waste management case. One thing to look for is consistency and patterns. Is a company always extending useful lives year after year? Are they constantly lowering their bad debt estimate while their competitors aren't?
So trends over time.
Right, especially if those trends seem out of step with the industry or the company's actual operating performance. If everyone else's garbage trucks last 8 years, and suddenly this company's trucks are estimated to last 15, you should ask why.
Dig into the footnotes again, I guess?
Absolutely. Read the footnotes. Listen to what management says on earnings calls. Do their explanations make sense? Do they align with what's happening in the business and the industry? Sudden, large changes without clear justification are definitely a reason to be cautious.
That makes sense. It raises another interesting question, though. What if a company doesn't just change the life of an asset, but the whole method of depreciation? Like switching from straight line to, say, double declining balance? That feels more like changing a rule, a principle, not just an estimate.
You're right, that's an excellent point, and it touches on a real nuance in accounting rules. Changing the method is technically a change in accounting principle.
So it should be retrospective then. Go back and fix.
Logically, you'd think so. But here's the twist. A change in depreciation method is actually treated as if it were a change in estimate. It gets that prospective treatment.
Wait, why? If it's a principal change.
It's because the reason for changing the method is almost always tied to a change in the estimate of how the asset's benefits are being consumed over time. For example, if you switch to an accelerated method like double declining, it's usually because management now estimates the asset is providing more value early in its life and less later on.
Ah, I see. The estimate of the pattern of benefits changes.
Exactly. Remember, depreciation involves three things: life estimate, residual value estimate, and method principle. Because the choice of method is so closely linked to the estimate of benefit consumption, the accounting standard setters basically decided it's often impractical to separate the effect of the principal change from the effect of the estimate change.
So they bundled it all together under the estimate change umbrella for simplicity.
Pretty much. So,
Yeah.
change in depreciation method, prospective application. It's a specific exception to the general rule for principal changes.
Okay, that's a really important distinction. Given all this complexity and the potential for, well, manipulation like we saw with waste management, what do companies have to tell us? When are disclosures about estimate changes required?
Good question. The disclosure rules really hinge on materiality and the nature of the change. For your sort of normal, everyday, minor adjustments, think routine tweaks to bad debt reserves or warranty accruals that aren't individually material, disclosure isn't generally required. You don't want the financial statements cluttered with tiny details.
Right, that would be too much noise.
Exactly.
Eh.
However, when an estimate change is material and is expected to affect several future periods, then disclosure is definitely required.
Like changing the useful life of a major asset.
Precisely. That's the classic example. The Atom Company change, if material, would need disclosure. The waste management changes absolutely should have been disclosed and explained honestly, which they weren't. When disclosure is required for these material changes, the company needs to tell you the effect on income from continuing operations for the current period.
And, if applicable, the effect on earnings per share or EPS for the current period.
So you can see exactly how much that change impacted the bottom line and per share results right now.
That's the idea. Give users clear visibility into the impact of the change in the year it happens. Of course, companies can always disclose more if they want to be transparent, but those are the minimum requirements for material changes.
Okay, so we've covered a lot of ground here. We started with what estimates even are informed judgments, not just guesses.
Right. Necessary, because the future's uncertain.
Then how changes are handled, that key prospective approach, no going back.
Which is simpler, but means you need to watch trends. And the absolute necessity of good faith. The waste management case really hammered that home. A $1.7 billion warning.
A very stark warning, yeah. Ethics matter.
We also cleared up that tricky bit about changing depreciation methods being treated like an estimate change.
Yep, prospective application for those two.
And finally, the disclosure rules material changes affecting future periods need to be spelled out in the footnotes, showing the impact on income and EPS.
What's really fascinating when you pull it all together, I think, is how these seemingly small technical adjustments, changing a useful life by a few years, tweaking a salvage value, can ripple through the financial statements. They can significantly alter reported profits, sometimes dramatically, and if they're not done ethically, like we saw, they could be tools for major financial fraud. It really underscores why you need to look behind the numbers, understand the why.
Absolutely. It's not just about the final profit number, it's how they got there. So for everyone listening, as you look at company reports, pay attention to those estimates. Are they changing frequently? Does the explanation make sense? Don't just glance over the footnotes. Think about the potential impact these changes have on the company's reported story. And if you want to dig deeper and really get comfortable with these concepts, definitely check out resources like farhatlectures.com for more practice and explanation. It's a crucial area.